Hello, everyone. I'm Najeeb Baqui, founder and managing director at Tinsley Park, a private equity platform and an advisory firm. Welcome to another episode of Tinsley Park Talks, which is a global networking platform where we interview industry legends from finance to tech and from policy experts to great thinkers. In these digital interviews, we talk about investing, entrepreneurship, solving complex problems, and all other lessons of life. Today, we're going to talk about the state of private equity and venture capital fundraising. And our guest is David Conrod, who's the co-founder and chief executive officer of FocusPoint Private Capital Group. Prior to co-founding FocusPoint, which raises capital for private equity, credit, real estate, real assets, and direct transactions in both developed and emerging markets, David was a senior managing director at Guggenheim Partners prior to FocusPoint, where he established its private fund group, obtaining more than $7 billion of fund allocations for general partnerships external to the firm. Great track record. I personally haven't worked directly with him, but David was responsible for helping raise an institutional fund for the last firm that I worked for. And that was the relationship. And it's always great to pick his brain whenever I'm thinking about raising my own fund and just getting a pulse from David. I don't know any other expert than David to talk about the state of fundraising and overall private equity and venture world. Welcome to the show, David. Pleasure having you.
Thank you for having me, and it's a real pleasure to participate in your podcast today.
Great, David. So, David, tell us about your upbringing. What shaped your life growing up? How did you choose the career you did, your academic career, professional career? How did you end up in private equity?
Yeah, that's a great question. Thanks for that. I grew up, I was born in Washington, D.C. My father worked for IBM as a salesman, and my first 8 years I lived in DC, LA, Seattle, Boston, and New York, where he became the national sales manager, and probably watched and learned a lot about selling, from him. But I went to, after college, I was in the software business, selling application software. It was an online banking system that ran on an IBM mid-range computer. And I learned a lot about selling software, which is you're selling the future. And one thing in software, you learn that you never say no. If they ask you if the system can do it, you say probably instead of no. And it's very different. Then I went to business school, and after business school, worked with, wanted to get into the investment management business, and took a position with the HSBC Group as head of sales and marketing for the Americas. The HSBC Group was on an acquisition binge in the early 90s. And that led me to a group they had in Hong Kong that had a direct investment business with a couple small private equity funds. They built a little bit of a track record and, wanted to try to raise some capital from investors in the United States. And that was in 1992 or 93. And the individual that ran that direct investment business for the HSBC Group took me down to, I guess Merrill Lynch was the only placement group in the business at that time. Had a meeting there and was, learned that a 2% management fee was much more interesting than 75 basis points on a long-only Southeast Asian equity mandate. And I think that's what got the bug. And I convinced the partner there that I had the relationships with these LPs. I could raise it. He didn't need to hire Merrill. And so we did that. And I think what allowed me to do that was, we were at HSBC, we were raising capital for a long only Southeast Asian only equity mandate. And so only the largest institutions in the United States were that well diversified in the early 90s to allocate capital there to an actively managed account. So I had some pretty good relationships with some large experienced investors, and those were the buyers of the fund. And I think we raised 250 million for China and Southeast Asia. I think the final closing was in 1994, mid-year. And I think at that time is the largest private equity fund ever raised in Asia. Wow. And then we, the bank backed a team in New Delhi, and we raised a fund in India. And about 50% of the capital came from institutions in the US. That was very early days. And then we raised a little over $500 million in 98. I think it was probably, again, the largest Asian private equity fund. And then Indonesia blew up when the rupiah went from 2,000 to 20,000. And then the Americans came in and took.
That's the Asian crisis, correct?
Yeah, the Thai baht crisis, and it spread pretty quickly. And Indonesia, was, all these businesses were US dollar borrowers, and their earnings were in the local currency.
Right.
And it was difficult. But
Right.
then the American private equity firms came in and, have done incredibly well, building out their team and their presence throughout the Pacific.
Something similar going on in Sri Lanka right now.
Mm-hmm.
It's pretty interesting.
Yeah.
Cool. That's a great journey. So since you back management teams, general partners, can you talk about a process of evaluating a new fund manager or team, and maybe mention a name or two of funds that maybe we've heard of?
Yeah. So I left HSBC Group end of 99 and teamed up with some friends that I knew. And in October 2000, we formed a firm called Guggenheim Partners. And so I was there at its inception and ended up running our distribution business for Guggenheim sponsored as well as third-party assignments for a little over 10 years. When I left middle of 2010, and several of us here at FocusPoint were on that distribution team at Guggenheim. We did a lot of first-time funds, at Guggenheim, that were sponsored by Guggenheim, as well as through the broker dealer network. We always wanted to stay in the market with third party, just to give us better deal flow, better access, and continue us. And it was good to always be seeing other investment talent than just what we had grown internally. And we raised, I think we've probably done well over, between Guggenheim and here at FocusPoint, we've raised capital for well over 20 fund ones. And they're more motivated, they're smaller teams, better, probably more crisper decision making between them. And I always learned, a good friend of mine was at Harvard Management Company for 18 years, where he ran the private equity business.
Is this Stu Porter?
No, it's an individual named, I won't name him. He's okay. He left about 5 years ago, but I think he joined the endowment when it had about $3 billion in the endowment, and he left when at about $36 billion, and probably allocated about $18 billion over 15 years to private equity firms. Put a lot of groups in business. So when Harvard was the first money in, a lot of other well-known endowments would probably draft off of that, and the GP would be funded. And I always remember, he looked at the world, he divided his managers into 3 buckets: rising stars, established stars, and fading stars.
How do you evaluate the fading stars? I think that's more interesting.
The large, maybe more motivated by fee streams than carried interest.
Sure.
Yeah. And so a lot of the new groups are more motivated and generally seem to do better, funds 1 through 3.
Yeah. David, if you could think of one first time team that you backed when you first saw, let's say you evaluated the team and you said, hey, it's a very unconventional. Institutions are gonna, just say no right away because of all the deficiencies that you've already seen from your experience. But then you yourself was surprised how they, probably had raised any names, any kind of, not if not names, any kind of a fund or team that you've seen that had very unconventional characteristics that were successful ultimately, and then maybe we could still see them around.
I've got a couple. I'll give you two examples. One, I would say in 2000, we just started, we just formed Guggenheim. The NASDAQ had blown up about 4 or 5 months prior to when we formed the firm, and maybe 01, a law firm that was in the fund formation practice introduced us to a new group. And they were young guys, young, energetic guys. They were classmates at HBS. One was a VP at TH Lee, I think, and the other was at a venture firm. And they were looking to do a buyout fund with a tech angle to it. I think it was a few months after Silver Lake probably raised their initial fund. And they, these were fairly junior guys. We looking to raise 300 million. I think they switched gears in the middle of the process and just started to focus on industrial buyouts and specialty industrial, more buyout focus, which was the skill set of the individual at TH Lee. It was a tough fundraising practice when the NASDAQ had collapsed, and a lot of investors, when they rebalanced, they were over their private equity target. But they bought a business that was acquired a business that was owned by a very big, I call it a special situation firm, and the principals there rolled their equity into the deal, and then a number of the limited partners in that other firm came into Arsenal Capital Fund 1, and they hit their 300 million target. We have worked with Terry Mullen at Fund 2, which was 500 million. Got a very big, well-known endowment came into the Fund 2, and we've worked with them on multiple funds. And today Arsenal is, got to be one of the best track records out there. I think the last time, I saw Terry in December, and they've been compounding it over 40% and almost a 3.7 net multiple over the last decade. And he's been, his communications with his limited partners are, second to none. And he's got a great team, and branched out into healthcare from specialty industrial. He's got those two sectors of focus, and there's nobody better at what they do. More recent group that we worked with is, we met them in 2010. A very talented individual came out of W.P. Carey. He was there for 18 years. He built their European business from zero to the dominant player over that time. Had an SEC audited track record because it was a public company.
Sure.
So we launched Fund 1 with that track record. We were able to, Fund 1, a New York Stock Exchange listed insurance company, and a, top 10 ERISA pension fund came into Fund 1 at the first closing, and two great, well-respected names like that helped them get away with their initial funds in, I think, 2011, 2012 timeframe. And that firm now has over 5 billion in AUM, headed to 8 billion.
What was the
and they're the dominant. they're a dominant firm in North America and Europe right now.
Nice. What was the unconventional aspect of them? Just coming from a public background, getting private?
The strategy didn't fit anywhere.
Okay,
It's sale leaseback.
I
Right?
see.
It's a hybrid between real estate and credit.
Right.
So the real estate groups are looking for 20 plus returns, right? And they don't understand credit, and the credit guys don't know real estate. And they're looking at the downside, and the skill set required in the sale leaseback is you got to meld the two and then determine what's the real importance of that asset that you're going to back. But in this market, it's a great strategy because it's another non-bank source of financing, right? So if you're the CFO of a corporate, you can do issue more equity. You can do a bond offering, right? Those are what the investment banks are going to promote, probably because the fees are better.
Right.
Or you could do a sale leaseback. If you look at the balance sheet of any business, property, plant, and equipment is probably the biggest line item.
Right.
Why are they in the real estate business? Why not sell a choice asset and simultaneously release it back for 15 to 25 years? Company, for doing so, they're going to want to pay a below market rent. And the manager say, okay, I want to buy this asset for a below market price, which is usually what happens. And then you're protected against inflation because you have rent increases built in contractually. And, you're getting, for good credits, you're probably getting 3 to 4 times where the equivalent corporate debt trades. So, you might be getting an 8 or 9% cash on cash return for a Amazon sorting facility where the bonds traded too, right? Mm-hmm. And you're fully collateralized and you own the asset. So I think a lot of the big cap, large cap private equity shops are now targeting this sector. Do they have this? Are they going to have the ability to think through? Are they just going to allocate it to the real estate guys or the credit guys? And
right.
How is that going to work out? We'll see.
Very, very interesting. Okay. Can you walk us through the private markets landscape since you started in the 90s and then what you're seeing now? Maybe in terms of the number of firms that you see out there then to what it is now, or
sure. When we were raising these Asian private equity funds in the 90s, for example, there were five names, that were, and 250 million was the largest fund, small.
Sure.
Very few investors were allocating capital to international private equity. Right. Mainly it would be Europe, and to get somebody to take a flyer on Asia was even more.
Is this before Jordan Company, where they were one of the first international PE firms, right?
Yeah, they've been there, but I'm just thinking about, Prudential Asia was probably the first main. There were a couple other groups out there before HSBC, got in there. But just thinking about the presentation back then, it was all based on demographics. We talk about, rising levels of disposable income, which would lead to more purchases of basic goods and services. So instead of a family, it was a very crude example, a family content to eat off a box placed in the middle of a floor, they'd buy a table. So you'd want to be manufacturing furniture, and you want to be where there's large populations.
Sure,
right?
sure.
Now, these limited partners are very experienced, very knowledgeable, and that sales pitch just would not fly anymore. It's not going to happen.
We're also going the other direction from globalization. So,
yeah, and I think even at Guggenheim, we were very successful with some aviation aircraft funds, and we launched those funds in probably 04, 05. So it took a while to recover for passenger to, business to recover after 9/11. The load factors were way off, and you've even seen a continuation of that. 15 years ago, when you would fly to the West Coast, it'd be a double aisle. Now it's all single aisle.
Right.
So the wide bodies are in the desert. It was even more pronounced back then. And so our team was buying, the management team was buying some used 747 in passenger configuration. And the strategy there was to convert them into freighter and take advantage of the global supply chain, moving to just-in-time delivery with more component parts coming out of Asia to the West. And I think that fund one, we raised 277 million and we acquired 52 aircraft and 3 engines. And that did very well. And we sold the whole portfolio to a publicly listed leasing platform and made about, I think, 2 times money in 14 months, something like that. And with that, we had a track record to raise fund two, which we did.
Nice.
Yeah.
And so, in the sort of last 5 years or so, what's probably the most surprising or sort of uncommon nuances that you're seeing in the just a general LPGP dynamic?
Well, first of all, I think if technology is, if I look back at the roster of groups that we worked with 5 years ago, maybe 1 or 2 had a real technology angle.
Mm-hmm.
Now there's a tech angle to everything. Everything we see, even with a distress or control manager, they're turning around a business or restructuring a business. How is technology going to play, with their business plan? And it's everywhere. And having that skill set and understanding of how you're going to take advantage of technology, even a generalist private equity manager in the lower mid cap is going to have to understand that and bring in that skill set to be able to compete.
Yeah, makes sense. So, with technology, we must talk about VC, but we're getting there in a couple of questions. But maybe you want to talk about 1 or 2 transactions that you're really proud of. You mentioned a few, but just if you were to talk about one transaction you worked on that's like your marquee deal, lifetime deal type of a deal.
I could talk about a recent co-investment in a fund that we're working on.
Sure.
Maybe. We got to know a sovereign wealth fund that has a special situations team, but they just happen to be in Brazil, and they've been down there for about a decade. Very talented team. And if you think back to March, April 2020, when the pandemic was just breaking out and oil was going negative, when the Saudis and the Russians were attacking the U.S. shale sector.
I remember that Sunday evening.
For being in Houston, you would know.
Absolutely. Right? Yeah.
So, at that time, so oil's going negative, believe it or not, only 2 years ago, right?
Yeah, negative 40. I have a screenshot of that on my phone.
Negative what was it?
Negative 40.
Yeah, negative 40 2 years ago. The Petrobras was going through a divestment period program, and their second largest refinery was being auctioned, and the pandemic is breaking out. Oil's going negative. All the majors were not in position to bid because they'd be unable to travel to conduct due diligence.
Yeah.
So the sovereign wealth fund was there, had the skill set on the ground, and I think they bid not quite sure, but about 2.6 times EV for the asset. I think it was an $820 million equity check. That transaction closed November 30th when oil was 70. And at that time, I think the base case was 9 or 10x. So it's it's improved since then. And I think, this could be one of the best PE deals of the decade.
Wow. Yeah.
Right. So that was really interesting. So we were able to identify, some investors to participate in that. And I think being in the capital raising business, in some aspects, we're like a search firm because we just meet investment talent all the time, whether it's LPs, talented GPs,
Right.
et cetera. And, another interesting transaction or sector that we're focused on right now is the Latin American market in the US. So the US Latin market is the 8th largest economy in the world. It's bigger than Brazil, and it's growing at almost 30% per annum, and the rest of the US is growing at 3%.
That's amazing.
So we're working with a group of big families that have been actively acquiring brands that sell into the Latin market in the United States. And so that's very interesting to us. And that could be culinary, snacks, coffee, things like that.
Interesting. And you mentioned there was another a tech SPV deal. Can you talk about that?
Yeah, we've through our networks, we've been introduced to some very talented guys that have launched their own firms after being partners at some of the most successful venture firms in Silicon Valley. And for example, one group has got 2 funds. He was the founder was a partner at a big firm for 4 funds, launched his own firm in 2016, raised 2 funds, a little over about 350 million of AUM, and doing seed and Series A generally.
Mm-hmm.
And one of those portfolio companies, was doing a C round, a pre-IPO round, and their pro rata was about 20, but they couldn't take all of that. They didn't want more than 10% of their AUM in this one company. And so we were able to put together an SPV to invest alongside 2 real quality groups. So
great.
I think we've been using, it's not quite asset management, I would say, but we use the capital raising business to source interesting transactions where we are able to participate in the promote structure.
That is very interesting. That leads to the sort of next question on, what are you seeing out there in terms of the private equity and the venture capital world and how they're converging together in strategies?
I think a lot of capital has been raised, and these large funds have gotten larger and larger, and as they have their platforms, portfolio companies, they're looking to add on, and so they're stepping up and buying. I would say if you're a growth equity manager and your portfolio companies get to 100 million in revenue, you show up on the radar of everybody. And, that's the game. Buy it when it's doing 30 to 50 million, grow it, at 100 million, somebody's going to take it. I think 5-10 years ago, there wasn't that food chain around where these, is either an IPO or a trade sale. You weren't doing a secondary sale to another private equity firm. It wasn't that the competitive intensity, among those well-capitalized larger firms, looking for assets. So it's a new avenue, for liquidity for the smaller firms. And I think you're seeing that in the cryptocurrency market now. A lot of new, we just had a group in yesterday, some very talented guys, and they're investing, in these newer companies doing seed Series A, anywhere from 250 to $1 million investments, and their hold periods are 3 to 9 months on average. These larger funds are coming in and just buying their assets, and they're making 3 to 4 times within a year. And so it's almost a micro version of what's happening in the growth equity world with the private equity funds.
And are these a single asset SPV kind of deals?
Yeah, they would be, just portfolio companies of these. So you might have a smaller cryptocurrency fund that's got 15, companies they've invested in, and it's very short hold. It seems to be a lot of demand. So we're doing a little work there. Haven't gone for it yet, but we're learning. And I think it's like fire insurance, I think, right? You need to have it, but some of your allocations should be there.
Okay, so that was going to be my question. So you do believe that there should be some allocation.
Yeah.
Do you have like a number in mind, like what percentage of a portfolio?
I think small, 1%, 2%, fire insurance, right?
Right.
Yeah.
Interesting. Okay. Well, I know you've got a flight to catch, so we're not going to keep you long, but what are you reading these days? What are you streaming? Any suggestions?
Oh, I just bought the $1 Billion Whale on Amazon last week. I want to read that story about the Malaysian.
Yeah.
I think his name was Joe Low.
Yeah.
How he swindled Goldman Sachs, Hollywood, and a lot of other people. Yeah. So, it's a good read for a plane on a Friday, right?
Right. Great. And then finally, what career advice would you have for young professionals that watch this show to get into private equity?
Yeah, I think,
or venture capital,
I would say, it's amazing. Venture, I think you want to be on the credit. I would say I would get some credit experience. That would be invaluable anywhere you go, and try to find a credit related firm if you can find an internship and work your way in. But I think getting some type of training in credit, would be invaluable.
Awesome.
And
for funds that want to get hold of you, what's the best way to get in touch with you?
Sure. Our firm email at the firm. Name of the firm is FocusPoint Private Capital Group. That's FPCGLLC.com is our website, or email me directly at dconrod, CONROD at FPCGLLC.com, or we have a LinkedIn page that has a little bit of information as well.
Awesome. Well, David, thank you so much. Have a safe and fun trip with the wife, and say hello and my regards to her, and we'll be in touch.
Okay, Najeeb, I really appreciate it, and thank you for your time.
Always awesome to talk to you.
I enjoyed it.
Have a great weekend. Bye.